Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, unable to find a pen here, but anyway, what this shows is the dollar has moved in some major bull and bear market trends. When the dollar first started floating, it moved downward in a pretty big downward pattern into 1980, 1982. Then had a big surge up when Paul Volcker, and I've noted these on the charts, these major changes. And the point I want to make is the dollar tends to move in these major macro trends. Of course, with the beauty of hindsight, we can identify these things. But it moves in these macro trends based on major global sea change macro events in the world. The change in the interest rate policy in the U.S. when Volcker squeezed inflation out, pushed the dollar in a bull market. We had the Plaza Accord where the dollar was overvalued and the major central banks in the world pushed the dollar back down. Then we had a tech boom in the U.S., which brought a lot of money into the U.S., pushed the dollar up. Then we had the bubble crash and we had the potential for deflation in 2000, and that's when U.S. interest rates were pushed all the way down to 1%, lower now at the time, which was the emergency Fed funds rate, and we had creations of all kinds of derivatives. So the dollar's been in a pretty nasty bear market from around 2001, 2002 time frame, bottomed in March of 2008, and it made a pretty strong bounce in the midst of what we call the credit crunch. And we happen to think the credit crunch could be an absolute sea change or a game changer, because there's no doubt it's a major macro event, the likes that we haven't seen in our lifetime. And we definitely think it could be a game changer, which leads to the point here, as I've placed in the yellow box, really the three scenarios in play. Was this move off of the bottom on the credit crunch move from about 70 in the U.S. dollar index, was this really the beginning of a major bull market in the dollar, scenario 3? Or was it just a bounce in this long-term bear market that started back in 2001, 2002, and we're in some type of controlled bear market? I say controlled. You never quite know if these things are going to be controlled, which leads to the potential for a dollar crisis, which is point number 2. So are we in the type of bear market where the U.S. government is very happy with the dollar falling? And those are really the three scenarios in the market. The controlled bear market scenario is the idea that the U.S. is the funding currency and it gradually just falls over time. And get to some of the reasons for that. Before I do that, I just want to give you another more close-in look of where we are in this dollar bear market move and its move since it bottomed in 2008, because I think it's important. What I show here in the blue line that you see there, the blue line represents stocks, and it's the S&P 500 there. The red line represents the U.S. dollar index, and the maroon line represents commodities. Commodities, gold, oil, food, all those things are wrapped up together in the commodities index. And the point I want to make is, as you look up at the upper left-hand corner of that chart where the U.S. dollar top back in early 2002 and came all the way down, you can see the other two lines went up, 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 which shows that the U.S. dollar really, in effect, was funding these other asset classes. A weaker dollar, really, because it's the world reserve currency, means that global asset markets are going to be juiced around the world, and that's exactly what we saw. And we saw a very tight correlation in this cycle, more so than we've seen any time before, of this weaker dollar, and stronger global asset markets. Every other asset class you can almost possibly think of went up during this time period when the dollar was the driver going down. And a lot of that had to do not only with the U.S. low interest rates, U.S. wanting an implicit dollar weak policy, but there's a massive amount of U.S. dollar credit created during this period by what we used to call investment banks, which are now gone, creating all that derivative credit. Derivative credit was mostly dollar-based credit that was pushed all over the globe, and in effect, you think of that as dollar supply weakening the U.S. dollar, but pumping up asset markets around the world. That period of, as we just got into 2008, when the credit crunch really was recognized for what it is, that's the red period there in which the dollar bottomed and made a big bounce. You can see the red line coming up during that period which was the credit crunch bounce or the realization. You could also call it the big risk aversion bounce when the leverage came out of the global markets, when everybody was very, very scared. And the reason the dollar rallied from the low there is people came running back into the U.S. markets to hide. And when they did that, they sold off stocks, sold off commodities, sold off risky assets, and went in and bought U.S. treasuries. And when they buy treasuries, it means the U.S. dollar goes up because it gets a big wall of money coming in. That's what we saw during that period, that risk bid period or risk aversion period. Commodities broke right at the same time the U.S. dollar rallied. Then we got into what I call the green shoots area. That's when everybody was expecting China to continue to grow, and commodities started up as China started stockpiling, which we didn't know for months till months later. But the people that got on early in this green shoots idea saying the worst is over were very, very right, because we've seen massive rallies in commodities, massive rallies in the stock index during this green shoot period, and sure enough, the U.S. dollar has tumbled during this green shoots area. Again, the green shoots area, because of the fact that the capital gains opportunities now in the world are mostly offshore and in Asia, when you have these relative growth opportunities or these risky asset trades, people wanting to put money off into high capital gains potential territory, that means offshore now, and again, mostly Asia. So we saw the money flow out there, and we saw a continued growth in China, again, which surprised us a bit. We didn't expect China to be able to keep this game going, but they put a massive amount of money in their economy over the first 6 months, almost $2 trillion in a $4 trillion economy. So they almost spent 50% of their economy in stimulus, direct bank loans, or direct stimulus and bank loans. Keep in mind, China owns all the banks, and they direct where, when they should spend money or lend money, and where they should lend money. So when China does a stimulus, money gets to the market right away wherever they want. The problem, of course, with the U.S. stimulus is we can't tell the banks exactly what to do. At least the government would like to. But when we put a lot of stimulus money in the market, often it goes and sits on banks' balance sheets so they can use it to shore up their own capital, and we're also seeing just a decline in lending across the board from people that don't want to borrow like they did in the past, and those that want to borrow can't borrow because the credit standards have hiked up. So our stimulus on a relative basis has not been as effective as China's. So China's kept the music playing, and the growth continues and it continues. We're in that period right there, that yellow period, which I think we start to call the area of global recovery. I think most major economists have said the worst is behind us and we are in the recovery phase. I still think that's an open question, but that's where we are. So now we're in a period, if we assume that we're in a recovery phase, global healing is here. Credit markets have eased tremendously, so much so, of course, interest rates have fallen in all the major central banks around the world. In fact, the U.S. has fallen the most when you look at the short-term rates, and that's part of this idea that the U.S. is, again, the funding currency because rates are so low, and I'll get to that in a second, now relative to the other major currencies.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.